that opportunity that you think is like, I got to jump on it now. I promise you, man, it comes around again. It comes around again. It comes around again.
Welcome to the Real Estate Investing School podcast. I'm your host, Joe Jensen. Our guest today is Jason Henneberry. Jason's the co-founder and CEO of Tango Financial, Canada's largest mortgage broker. He's also the co-founder of the VIP Club and Strategy Hub. He's helped 1,000 realtors and mortgage professionals improve engagement and build better relationships with their clients. He has over 20 years of experience in the real estate space and is widely recognized for his knack in helping realtors and mortgage professionals with the marketing and sale of real estate and mortgage financing. So Jason, welcome to the show. Glad to have you here, man.
Joe, thank you. You read that perfectly. You left out the part about me having a PhD, though.
Ooh, can't miss that. He's got a
can't
PhD.
Miss that. It's a public high school diploma, which
that's my kind of
which tells me
PhD.
about this much in all of those endeavors.
Exactly. I was going to say that's my kind of PhD, but I didn't even get that. I didn't even get my high school diploma.
Right on.
I did get a bachelor's in science from university, but no high school.
Sweet.
So there's no right or wrong way to do it, you know?
There's no right or wrong way to do it, man. Not these days, that's for sure.
Well, this is cool. I'm stoked to have you on, man, because something unique about your situation compared to a lot of our guests is you live up in Canada, you work in Canada, you lend money in Canada, you connect, it's a different world up there a little bit, which I'm always interested in interviewing people from other countries and how real estate looks to them in their country and how they look at real estate in the United States. What are the pros and cons?
Yeah, we definitely have different markets, and it's great to have the opportunity to swap stories and see where the conversation takes us. So happy to be here.
So just to start on that, in my mind, so this is what I hear about Canada, and again, I've never invested in Canada. I don't know anybody that does, but it's like, oh man, they're really expensive. Like the homes are really expensive, and you don't have as generous of financing options as we're used to down here with like a 3 or 5% down, 30-year locked, long, low interest rate. But maybe that's hearsay. I don't know. Tell me what's it like investing in Canada?
I think you're not wrong. I think we probably have a little bit of a tighter regulatory environment up here in terms of like the lending products and things like that. So it's harder today than it was 10 years ago to get into real estate.
Sure.
My whole background is mortgage finance primarily, and then I get a kick out of the marketing side of things. So I help people with that. But when I first got into the business, and this is going back to like I've been doing this for 20 plus years now. So 2004, you could buy an investment property in Canada. We had mortgage products up here, and I think you guys had similar, where you could put zero down. You could actually get a cash back financed on the purchase. So you were basically borrowing 105% of the property value. And you could do that with very little paperwork. And that is like, we couldn't be further from that world today.
Right.
Like now it's like, you gotta give a blood sample and plan a rate born if you want to get a mortgage. But man, I wish I could go back to those days. I always look at it and I'm like, why didn't I just buy like 100 properties, zero down back then? But the hindsight is 2020, obviously.
Yeah, well, and then that led to its own world, right? Because we were doing the same thing here down in the States, and they're doing these what they call signature loans. Basically, you just sign the paper. Here's the money. You don't need to have proof of income or proof of employment. And if anybody's ever seen The Big Short, I don't know, have you seen that movie or read the book?
I was just gonna say, there's those two mortgage guys where they pull them aside and they're like, why are they bragging about this kind of thing?
Yeah, and it's so funny because I've read the book, I've watched the movie, and it's so good. I recommend everybody go check it out. Just because it's an insight of like what is possible out there, how wild things really are. You just think that everything's being so structured in specific ways, and it's like there's a lot of manipulation and weird things going on. And that leads to obviously what happened in 2008, where we had this huge housing bubble and it blew up the whole market down here. At least, how was that up in Canada? Did it affect you guys the same, or was it you guys insulated from that?
If you owned and held real estate through like obviously there was an impact in 2008, and I can tell my own story because I had a hard time for about 2 years after 2008 for totally other reasons.
Oh,
But if you owned and held your property through the end of 2009, then you were fine. So it was, and things came back up here, and then they stayed strong up here right through to 2022. It just kept. There was publication after publication, like it's a bubble, it's a bubble, it's a bubble. Like I remember, like 2013, people were panicking, and it just never popped, and it still hasn't popped up here for except for the major markets. So height of the market for us was February 2022. And if you're in the big metropolitan area like Toronto or Vancouver, definitely we've seen a decline in some of the real estate values, but not like you would have imagined.
but not like a drop, a collapse,
Nah.
like cutting in half the prices. Just
the thing that people don't realize about Canada is how much equity Canadians have. Like only 50% of homes have mortgages on them up here.
Interesting.
Yeah, and that number may be a bit different today. Maybe it's 35%. Like these things, I'm just going off of like my memory of some stats. But and the people that do have mortgages, like the amount of equity is really, really, really high. And so nobody has to sell. And so right now in the market, like this last year or two, the transactions are low. There's not a lot of product moving off the shelf in terms of like people buying and selling homes, but nobody's dropping their pants. So the home prices are staying flat because nobody needs to. And when I say nobody, there is a small percentage of people, obviously, that, they buy high ratio, small down payment at the height of the market. Those people are feeling the pain, and I feel for them. But for the most part, our market is pretty solid from that perspective.
Yeah, that's interesting. And with for your interest rates, I don't want to like hit on lending in Canada for too long because probably most of our listeners aren't. But I'm curious, do you guys have 30-year locked with like 5% down, like 3% down? Like you don't really have those, right? That's probably one reason you have more equity is you kind of forced to put more down and pay
we are today you're forced to put a lot more down. If you're self-employed or if you're buying like investment properties or whatever, you tend to have larger down payments in order to get the mortgage products. But from a rate perspective, from a term perspective, we don't have 30-year terms. We have the longest you can get is a 10-year. I don't know anybody that takes them because they're priced out of the market. Most people will take a 3 to 5 year term on their mortgage.
So it's amortized for 3 to 5 years?
No. It's amortized. So two different things. Good question. Amortized over 25, 30 years, and you even have some 40-year products. But the rate and the term is only for 3, 4, or 5 years.
Yeah, and that's for like a primary residence even.
Hot primary residence, whereas in the States you get to lock your term in for 30 years, and you get no penalty, refinance. You guys have like a totally different landscape there. But for us, the homeowner bears most of the interest rate risk in the transaction, or the investor, as opposed to like if you could get a great rate for 30 years. So then the other thing that happens as a result of that is like we feel the changes in the market faster. Because like our homeowners and investors, like their mortgages are up for renewal sooner. So like we have most of the mortgages in Canada that have moved up in rate, whereas in the States, I think a lot of people that locked in for 30 years, like 4 years ago.
Yeah, that's interesting because right now it's only the people that are getting new mortgages that are like, oh, I can't buy a house now, or I'm frustrated. But for you guys, everybody that had existing ones is feeling the pain as well. That's why
we have the largest wave of renewals. And I know you don't want to, this is maybe kind of interesting.
I think it's interesting. I don't know. I'm loving it.
I think it's kind of interesting without getting into like the actual market too much, but like we have the largest wave of renewals ever right now in 2024, 5, and 6. Almost every mortgage in Canada is up for renewal in this 24 to 36 month period, because in 2022, when rates started going up, and you guys felt that too.
Oh yeah.
Everybody that was up for renewal then took short-term, like 1, 2, and 3 year terms because they didn't want to feel the pain of the rising rates. And so you have all those people coming up for renewal, and then everybody else that was on 5 year terms from before, they're also coming up for renewal. So it's like almost it's like 60-80% of all mortgages in Canada are being renewed right now, like in this
Wow.
period. Yeah, it's crazy.
Not a bad time to be a lender in Canada, I guess, then.
It's not, yeah, it's not terrible.
Yeah, you'll be keeping busy.
You still gotta help people. You still gotta. It's still a lot of work, but and you want to. Yeah, but we don't in the mortgage industry. We don't rely on the real estate transactions the same way that the realtors do. We just always have kind of, which is kind of nice.
Yeah, that's true, because everybody has to every 5 years. It's just constant. That's interesting. And what I think that's interesting for any listeners who are like, here in the States and are just like, dude, who cares about this? I think it's interesting to know what advantages we have. You know what I mean? So we take advantage of them, because so many times it's like, oh, people are sitting on the sidelines. I'm like, guys, like, imagine, like, if you were in Canada and you hear that you could lock your rate for 30 years, it's like that. You're so protected. It's like, that's crazy, guys. Like, we don't realize how good we have it. I mean, again, these are for primary loans. When we go do investment loans or commercial stuff, it's pretty similar. We got 3 to 5 year ARMs and, adjustable rate mortgages, and we'll have balloons and stuff once you get in the investment space, like commercial loans. But for primary residence, which a lot of people, a lot of the listeners, it's like a house hack. Everybody should every year go get that 3 or 5% down. I'd say 5%, avoid the PMI, don't do FHA, but go get a 5% down primary loan, lock it in for 30 years, and just do that every year, because you can. There's a whole country, every other country in the world basically can't do that.
Yeah.
So like, take advantage.
Yeah, your mortgage market is much different from that perspective, and ours is way more similar to, like, say, in Australia or even the UK to some extent. And so you have a unique. You're not wrong. You have a very unique product mix that you can leverage for those longer term buffers. It's very cool.
So you've touched every side of real estate, Jason, from the lending, from the personal investing to connecting and marketing and agents. Like, you've kind of touched all of it. I do want to talk to you a little about your personal investing experience, because you at one point owned quite a few properties and then ended up exiting a lot of them, not necessarily in a way that you were stoked about or like was planned on. Tell us, kind of break that down for us.
Well, this is getting back to, like, 2008 was rough for me for a different reason. So, I at one point, so how old would I have been? I was 30 years old in 2008, and so by that point, I owned. I can't remember the number. I kind of buried the memories because it was too painful.
Yeah.
But I probably had 20, 25 doors when I was 30 years old.
That's awesome.
Yeah, it was good. And it was a good time, and I didn't know anything but a rising market from the time I started my career in 2003 to 2008. I had 5 years. It was robust and making good money in my industry, and I loved real estate, so I bought a lot of stuff. But then I had a whole other program, and we don't need to get into this because this doesn't matter. But there's one other big fundamental difference between Canada and the US.
Yeah.
Your mortgages are tax deductible. Ours are not. And so the mortgage that you get on your home, you don't get any tax deductions for it. What we get is when you sell the house, you get to sell the house tax free.
Okay.
So, which is cool. So you get the capital gains, and this is a primary residence. You get the capital gains exemption on a primary residence when you sell, but you don't get to write the interest off along the way. So I had a really cool program that basically helped people convert that mortgage to a tax deductible loan, and it was awesome. And we promoted the heck out of that in 2006 and 2007. And we took like $1 billion worth of mortgage applications in a 2-year period back then. We had we put 20,000 people through 300 seminars across the country. It was amazing. And then 2008 hit. And I had made a massive commitment to marketing way in advance because you save your money. And so this is just a business lesson. But I was pre-committed for all of the second half of 2008 and the first half of 2009 on basically what was a 7-figure national marketing budget, radio, TV, the whole 9 yards. And then September 15th, 2008, bottom falls out of the market, and 0 people showed up to my seminars for the next 4 months.
Oh man,
yeah, it was brutal, and it forced me to. You can only do that so long when you've got that commitment to such a big spend that you can't pull back. And so I was way over leveraged from the perspective of a marketing commitment. And I
Yeah.
didn't have the incoming cash flow to offset. And so it took me out. It completely wiped me out. We had to sell my house. I had to restructure my business. I sold all my rentals. It was a
Wow.
dead stop. And by the time the damage was done, I had like $30,000 to my name. Uh, and, uh, and I had to build a new business from scratch. And this was like 2011. So it was like a 2-year period where I trickled along, and it was a total disaster. But a lot of good things came out of that. And we are where we are today. Like Canada's largest brokerage, we fund about $5 billion worth of mortgages every year.
Mm.
Got about 70 mortgage brokerages that plug into our system. Like, it was cool. Like, it's a good story in the end, but there was a moment of pain there where and I had to reset my portfolio, and that was not fun.
That is wild. It's so interesting because you're obviously more of like a businessman than anything. You're definitely in the real estate world, but you play that business game. You play big, you play hard. You've had the roller coaster, and I just think it's so interesting because it's like there so many people I know that own businesses. They've had these experiences like where they've virtually almost lost it all, and then they come back and they're making more money than most people know what to do with. And it's interesting because it's like real estate's so safe compared to that. It's like you make a little bit of money, you own a home, you get
Yeah.
some appreciation, some tax write-off, some cash flow, and it just slowly does that over time. And then you have a lot of equity, and then you buy some more. And it just kind of you don't hear these stories unless they were like flippers or developers. You don't really hear somebody like getting devastated and losing it all. But you
Yeah.
also don't go make billions of dollars with it. And so it's interesting. It's just such a I don't know. I feel like you have to have like a different spine, like to be able to
Sure. And I
withstand
want
that.
this to come across in the best way possible. Like, I appreciate the kind comments, but um, I consider myself successful in my own right, but not wildly, nothing crazy. So we're not talking massive wealth here or anything like that, but comfortable and happy. But you're right. I do enjoy building the business side. I'm okay to roll the dice a bit.
Yeah.
But what's cool about that is, young enough and early enough in the career to learn a lot from it. And what was interesting though, like I still loved real estate and my whole way of earning income, in the finance business. So it was still I still had to like figure it out. But the way that I got back into the market is I clearly didn't have enough capital left after that disaster to like go and buy a bunch of stuff. But what I did do is I did a lot of rent to owns.
Mm.
Because the one thing that I salvaged through that period of time was I didn't let my credit get damaged or anything like that. I dealt with the debts, and I made sure I came through clean. So I was able to rebuild really fast. I didn't have a long history to clean up. As soon as I got cash flow back in the business, I was able to go buy real estate. What I didn't have was capital. And so what I did is I got really big into rent to owns for a while, and we promoted them. We found people who couldn't necessarily get into homes but had some down payment saved, and I did a ton of those. And I helped people get on the property ladder, and then we co-shared the property. So I don't even know. Not like when I say a ton, it wasn't like I was doing hundreds, but I did like a dozen of them in a 2-year period. And that's, real estate market obviously came back 2011, 12, 13, 14, like, we all know the history. So those were really good years to be invested in a bunch of properties. And so, the combination of that and like rapidly getting back into the market and having access to some equity growth was really helpful for making up for lost time.
Yeah, let's dive into that a little bit if you don't mind. So
Yeah.
these rent to owns, I'm familiar with it. Actually, the first property I ever did, I ended up doing a rent to own out to somebody, so I could get a higher rent. I could get a little down payment from them. It helped me cash flow. Luckily, they didn't end up buying it because I still own that one today and have a lot more equity in it than
Yeah,
I
that
would have
happened.
ever imagined. But so I'm pretty familiar with it, but I'm not sure most of our listeners are, but I'd love to dive into that. So
Sure.
what was your strategy? And we can get nitty gritty here if you want with the rent to own stuff. Like, how did that work? Were you rent owning it as a purchase and then rent owning it as a sale as well and doing the sandwich deal? Or were you just on one
100%.
side, or how
So
did you
there's a
do it?
lot of ways. There's a lot of ways to to have wins for people. Like you can have win in a rent-own situation. You can have a win for the homeowner, like the tenant buyer. You can have a win for the realtors who are helping you transact and find the properties. You can have a win for the finance company who's going to help bring the deals together, because you're financing it on the purchase, you're financing it on the transition. So there's it's like a multi-transaction type thing. So it's good from that perspective. You can have a win for the person who's bringing the credit. So like oftentimes you'll get, say, a real estate group who's promoting it, a finance group who's bringing the money together. You'll have a tenant buyer who's got the down payment, and you'll have someone who's got good credit and solid income who will qualify. And so you're bringing tenant buyers and qualified investors together, and then you're creating a bunch of wins for everybody. So it really is, though, a down market strategy, meaning like the worst time to put someone into rent to own is when the market's as high as possible, because you pre-agree, like, okay, we're running this deal, it's a 5-year deal or 3-year deal. It's going to have, these are the exit triggers, like in terms of values and stuff. So you need, in order for everybody to win, you need the value of the property to appreciate over that period of time. So like the best time to do that is at the bottom of the market, and you have the most potential upside for everybody. And the worst time for the tenant buyer is when you're at the height of the market, because if they don't get the appreciation, then they've just paid more in rent technically for no financial upside. And it's harder to get them the mortgage so that they can ultimately be the owner. So that's why you said, like, sometimes they don't close, sometimes they don't convert to ownership. And but I think right now, like, it's kind of a down market, depending on the city, depending on the state. So rent to owns are potentially a good opportunity for if you're trying to bring a lot of transactions and a lot of partners together.
So break it down though. So for you as the investor, you bought a dozen of these or whatever. How were you doing it? Were you finding these? Like, how were you making money off it? What was your strategy with it?
So we promoted through. So for us as mortgage brokers, as a finance company, we need to find ways to like support our referral partners. And so we knew we could put these deals together from a financing perspective. And so what we need, though, is we need deal flow. And so we went to realtors, essentially. We said, hey, we got this cool program. Do you guys want to promote it to your clients? It's a down market. There's not a lot of real estate transactions. This is a great way to cause real estate transactions. And so they got excited about that and put our program in front of clients. So that was a win for the realtor. They were basically our distribution to find potential clients, both on the investor side and the tenant buyer side. So from a marketing perspective, we didn't have to spend any money, which, remember, my previous life, I spent a fortune.
Yeah.
So I got real, scrappy, and I found ways to find clients without spending any money. So that's great. So you can find deals and you can find investors through your partners if they're in marketing mode. And so in a very busy real estate market, you're never going to get a real estate agent's attention to help you market that kind of program. But a down market, it's a win. So that was the first part. And then we had to do the financing. And so we would basically, like, I personally did a bunch where I was the investor. So I financed the whole deal. I was the investor, and then the realtors brought me the tenant buyers. But I probably did I did like over 100 of them where we just supported the financing, and we were basically bringing the tenant buyer and the investor together and causing the transaction. So I did lots of those. And then you just got to be careful, because you don't want to put anybody in harm's way. Rent to own sometimes have a bad rap because you'll get bad investors who kind of take advantage of the situation and take advantage of the tenant buyers. You just want to make sure you have really good people in the transaction they're all there to cause a win. And I think that's really important if you're going to get into it. Just, there can be that risk. So, you want to go in eyes wide open and making sure you're finding good people.
So when you're lending on these, because I'm trying to like understand the detail here, the agents, they're not, they're bringing you people and shit. They're having a hard time buying right now. So you're not actually selling the home right then. And so, like, how are the agents getting paid? Are they waiting 3 to 5 years and then getting paid? As a lender,
okay, cool.
You're not lending yet because they're not buying yet. Are you buying? You're getting the loan later?
There's all kinds of reasons. These are great questions. There's all kinds of reasons why someone can't buy a home today, right? Maybe they're new to the country. Maybe they're new to being self-employed and they don't have that history that the finance companies want to see. All kinds of reasons.
Yeah.
Maybe they have damaged credit and they're rebuilding. Maybe they came out of a divorce. There's so many reasons why someone can't quite buy today, but they want to buy. And a lot of those people will have down payment savings. They just don't qualify for the mortgage yet. And they might need like 2-year run rate to get there, or 3 years or something like that. So, so that's one side of the transaction. And then the other side is the investor. And so what we did is we said, we would find the tenant buyer and we would say, hey, how much money do you have? What can we probably afford? If you rebuild your credit or you get back, you get your 2-year history of self-employed, realistically, we're going to be able to qualify you for this 2 years from now or 3 years from now. So let's go buy you that home today, and you go shopping, you find the home you want, and we will match you with an investor, and the investor will qualify for the home. So we caused a real estate transaction. So the tenant buyers, they actually got to buy their future home and live in it right away. They just didn't become the owners until we could finance them into that situation. So it was great. So you got people that can't quite get into a home that get to actually feel the pride of ownership immediately. Realtor gets a transaction and the investor gets tied up to someone who is like, who cares about the property?
So these investors are the ones qualifying for the loan. They're the one buying the property. But then now they have this really solid preset tenant that's going to pay X, you may even help with the down payment and pay higher rents or whatever. So like why is the investor wanting to do that? It's just a solid.
Well, the investor wants to do it because it reduces risk. So think about it. If you want to go buy a rental property, just a residential rental property, you got to come up with a down payment, right? You take all the financing risk on it. And then you got to go find a tenant, and that tenant may stick around or may not stick around. They may trash the place. They don't care. You know what I mean? So with a rent to own type situation from the investor's perspective, the tenant buyer is bringing the down payment. So you don't need to bring capital. You're just bringing qualification, right? The tenant buyer covers all the closing costs, everything. The tenant buyer agrees to pay, not only cover those costs, but to surpay, like to pay a premium, which then gets put aside as to help them build a down payment. But it fundamentally becomes financial buffer that the owner, the investor, wouldn't otherwise have if the tenant buyer goes sideways on them, which can happen. I'll tell you it's not really a funny story, but I'll tell you a bad one that I did where I was the investor. So there's all kinds of reasons why as an investor, you just bring your qualifications. So kind of investors that we had, they were doctors, they were dentists, they were lawyers, they were guys and gals, like they were just professional people who just wanted good deals. And then what's nice about the investor is they have a predetermined ROI. They know when they exit that deal, they know exactly how much they're going to make, and they get a tenant in there that cares about the property. So they don't have to worry about rent not showing up, and they don't have to worry about the place getting trashed. So maybe you don't get quite as much upside because you're sharing that equity growth fundamentally.
But they do share the equity growth. They actually get some of the equity growth.
Yeah, the tenant buyer's doing it because they get to get into that property 2-3 years before they otherwise would, and they get some upside in the deal. So everybody gets upside in the deal.
That's cool. Yeah, I mean, that's great. As an investor, like, hey, you don't have to spend any money. Okay, but then you get a piece of equity and you get a cut of the rent payments, and you're just making this return. And it's all real estate backed. You know what I mean? Like
this is how I got back. I came back to life. I had good qualification, but I had no capital. So I went and did a bunch of these deals, and within 3 years, I had 50% of all the appreciation across a dozen properties that were all transacting, and I got all that cash out, and I was able to look my family and my wife in the eye and be like, "Look, we're not broke."
Dude, I love that.
You know what I mean? Like it took 2 or 3 years, but that's how we got our capital back.
Well, and that's what I love about real estate is if you can get creative and find ways to help people, like you can really help yourself. So anybody listening, if they feel like you're sitting on the sidelines, I always say like, what are your resources, right? And capital is a resource. Sure, if you got $100,000 in the bank, you can probably do something. Credit is a resource, though. If you can just provide the credit, then you can make money. You know what I mean? And you could own portions of deals just without spending a penny of your own. So if someone's sitting on the side like, oh, I don't have this, I don't have that, it's like, well, what do you have? And it doesn't have to just be for rent to own, guys. Like that's how Jason did it, because of the industry and the market. And he was, you were working as a broker. He had all these other pieces of that puzzle. But
Yeah.
any random listener, if you have decent credit, go find someone that doesn't, but they know how to make some money, co-sign with them. Bing, you got a piece. Maybe they give you half, maybe they give you 20%. I don't know, figure it out. But it's like, I did that a deal with a friend of mine and I gave him the tax benefits. He's writing off a ton in taxes every year. He didn't spend a penny. And I was able to use his credit when I didn't have any credit to qualify for the home because I'd written everything off in taxes. And so anyway, there's just so many ways to put a deal together. And it doesn't have to be scalable. You don't need to do 100. Go do 1 or 2 or 3 or do 12. It can really get the ball rolling and shift your perspective. So anyway, I just think that's a cool strategy.
I went from 30 doors to 0 where I owned them all and lost my own home where I rented for a while. And then to like whatever, at any time, I probably had 6 or 7 of these things active because I was rolling through them. Right. And it was shared appreciation. So totally different approach, but it still works. Yeah. So you're right. Yeah. If you're making if you make, 60, 70 grand a year, 100 grand a year, and your challenge is you just don't have much in the way of down payment savings for any reason, lots of reasons. We're sharing our stories right now. It's, there's no shame in it. Go find someone that has the down payment, but doesn't qualify. Boom. You just buy yourself a place. So yeah, it's great.
That's cool, man. I love that. And connecting the right people is so important. That's something you've been really good at, is connecting all the pieces, marketing to the different players so that you can get people with the people they need to be with to be able to do stuff.
Yeah. But you don't need all those pieces to make it work. Go to a real estate networking event, talk to some people. What's cool about being at real estate networking events is I found a lot of my deals that way. There's a lot of people. If you're listening to this and you're thinking about becoming an investor, you're new to this world. So you probably have some of the pieces of the puzzle, whether it's you've got the income and the qualification, good credit, or you've got the down payment, but you don't quite have those other pieces. I promise you, go to these events. There's other people in that room that are in the same place, and they have the other parts of the puzzle. And that is something that I did a lot of back then. I do less of it now just because I'm busy with other stuff. But when I was in rebuild mode, I was really trying to find the people that had the other parts. And you don't know what comes of that. You make good partnerships. I still own real estate today with at least one partner that I met back then when I was doing rent homes. And that's 10 years ago. And we actually own a property together today.
I love that. Yeah. So I just had this idea for any listeners that, especially this would work really well for younger people that, that no family yet, just a single guy or girl. And they're just like, whatever. In the US, you can get, 5% down on a primary, even up to a fourplex. You can call your primary and only put 5% down. If you do a USDA, you could do 0% down anyway, you might have no money. You might not even have the credit, but if you can go and say, hey, I'll make it my primary. If you buy it, but you can use my primary, so you only have to put 3% down or 5% down, and you'll get a way better interest rate that's locked for 30 years. Let's go do this. So I'm saying, so if you're a young kid, you're 20 years old, you don't have the income, you don't have the down payment, you don't even have the credit, but you can say, hey, make it my primary residence. I bet you could find an investor that's like, hell yeah. So now I only have to put 10 grand into this thing, 20 grand in, and I can get this beautiful home because I'm only putting 3% in, and I get a lower interest rate, and I'll give you a piece of the equity.
Okay, you just touched on something super cool. So we might end up in a place here where the similarities aren't perfect, but what you just described is something you can do up here in Canada. And it's something that I've got 3 kids, 19, 17, and 15.
Okay.
And they're entrepreneurial. They want to get started. So they'll start buying real estate almost immediately as soon as they can, kind of thing. So it's just the way our family is. So, but one of the strategies there for a young person that is trying to get on the property ladder in Canada, you can own, you talked about put 4% down, 5% down. We call that a high ratio loan up here because high ratio relative to property value. Sure. Okay. So it's the same thing. we're allowed to you can only get a high ratio loan if it's your primary residence.
Yep.
So the coaching that I'm giving my kid, but you can do this multiple times, and you can convert the use of the home within reason. You can't like say I'm gonna live there and then rent it out on the first day, but you are totally allowed to change the use of that property and go buy another one. And so you can do this up to 3 times. And so my coaching my kids is, hey, let's, as soon as we can, let's go get you a small 1-bedroom condo downtown in a highly rentable area, 5% down. Boom, you're going to live there for a year while you save the 5% for the next thing of similar value. And you can maybe ladder up a bit on your value because your income earning potential might be a little bit higher. But as soon as you can, it might take a year, it might take 2. We're going to buy the second one, then you're going to rent out the first one. But now you've bought a rental with like 5% down, basically.
Yeah.
And so we're going to watch and repeat that. And then on your third, when you're moving from your third to your fourth, you're going to save the 20% that you need or whatever it is, so that you can go buy the home that you're going to live in for a while. It could be a condo or a home or whatever. But that allows them early to get into having like multiple units with very little down payment that are now, cash flow positive or whatever. So
Yep.
that's the strategy. If you can pull that off, it's a great thing. I literally teach my kids how to do that. That's going to be our strategy.
Yeah. It's what I call the POP, P-O-P, the power of the primary residency loan. Like the power of the primary residency loan, you just get so much benefit. And again, and here we can do it every year. It's not limited to 3. You can do it every year for your entire life. So it's like, you might as well. And then, like I said, the thing I was adding on to is like, you don't even have to save the 5%. You don't even have to qualify. Find a partner, but just use your POP, your power of the primary, and then go move into it for a year. That's what I'm saying. It works as a young kid. You're like, hey, I'm going to go move to this guy's house for a year. Now I'm going to move into this house for a year. And I'm going to move to this house for a year. And you're walking away from each of those with equity, ownership, and you didn't put a penny into any of them. But like me as an investor, if I have capital, I would love to partner with some kid and then make the down payment to do everything, but use his primary residency to make, so I don't have to put 25% down on a fourplex. I can put 5. Like, that's awesome.
So let's do the math, right? You could do 25% down and own 100% of the equity, or you could do 5% down and own half the equity. If you take that 5% and go 5 times, you own 250% of the equity.
Yeah, exactly.
Right. That's the logic. Like,
it makes, or if you can't do it 5 times, you could only do it 1, you own something. Because if you only have the 5% and that's it, it's better to own a piece of something than sitting on the sidelines until you saved up 25%, You
got. So do you guys have the same, like for us, the qualification is the hard part up here. Well, saving down payment's hard too because the property values are high, but like, your income only goes so far in terms of qualifying for the loans. And so that's like, so the coaching that I have to give my kids, I'm like, we need to get your income up as fast as possible. Coming up with a 5% down on a $200,000 condo is not the hard part, but owning 3 of them means you're now qualifying for like $600,000 worth of debt kind of thing. And so it becomes harder and harder to buy the next one, even though you could potentially do more.
Yeah. So, here, you definitely need to have, so if you have a co-signer that has the income qualifications, then you're good because they're going to co-sign on it. And they're using you as the primary necessarily, but they're actually putting the loan in their name as well. So as long as you have the co-signer, you're good. But for everybody listening, once you have a home and then you go and you rent it out and you have a full year's worth of rent payments, then on your taxes, you can show that it's what's called serviced. Like the loan is being serviced by someone else, by the tenant. And when you have a full year of payments and you filed those taxes showing this mortgage is paid by those tenants, then it's a wash. So your debt to income won't be messed up because yes, you have this $1,500 a month commitment on this loan, but you're bringing in $1,600 a month. So that covers that. So your DTI, your debt to income, isn't ruined, even though you're owning 3, 4, 5, 6, 10 homes. They're not saying, hey, you're responsible for 10 mortgages. You're only responsible for the latest one that doesn't have a year's worth of rent to prove it's serviced.
So we have that, and it's very similar. We have a new thing. Remember we talked about some regulation earlier on? We have a new thing called a loan to income ratio. And so now they also measure on like total outstanding debt to income. And so there is a limit to just how much debt you're allowed to take. even if it debt
Even if
service.
it's serviced.
Yeah.
Interesting.
Now they're not measuring currently. They're introducing this. They're not measuring the individual. They're measuring the institution, and so the institution has to maintain loan to income ratios across their portfolio.
Oh,
But
wow.
I think eventually they will push that down to the individual. But it does mean that institutions think twice before giving one person more credit, because they have to manage that loan to income over the whole portfolio. And what the institutions care about is they care about the relationship, because they want to cross sell all the other products. And so once they sell you one mortgage, they have the relationship. So there's no upside to
Mm,
selling you a second mortgage or a third mortgage. They want to go
yeah.
find another person to bring into the ecosystem. So
So let me
yeah.
ask you this, and maybe there's not. It seems like for the most part, Canada is stricter and has less advantageous policies for this
Yeah,
stuff
we're
than,
not as fun as we're made out to be. Like
yeah.
we're not.
Is there any niche piece of real estate in Canada that would maybe make a US investor be like, oh, I should go up there and tap into that because I can't do that here?
So I write I have a blog that I do, and I look at all financial strategies, and I write about all financial strategies, and they're Canadian focused. And they could be like from real estate to finance to wealth planning to tax. I kind of geek out on financial strategies.
Cool.
It's my thing. So just recently, just like in December, I did an analysis. So there's an investing rule called the 816 rule. It's a very loose rule of thumb. You might have heard about it before, but basically, if the property that you're buying as an investment, if the monthly rent is, or the annualized rent is between 8 and 16 times like the value of the property, basically. So like if you had a a $200,000 condo that you were buying, divide it by 8, right? So if you can get that much monthly rent, you're cash flow positive for sure. So if you take the rent and you divide it by the property value, if you get a number that's between 8 and 16, that property is probably going to cash flow. If you're below 8, you're golden. If you're above 16, you're probably going to be underwater. So we analyzed in December for the blog 21 Canadian cities, and there's a surprising number of markets up here that are between 8 and 16 right now, even
Mm,
with like the weirdness in the economy and all this kind of stuff.
sure.
So there's a lot of markets where you can still get positive cap. You'll never get it in Vancouver, Toronto, or the big cities. Like that's impossible. You're running ratios like 25, 28, 30. It's bad. But in like rural settings, like just smaller towns, you can get good cash flow. So the arbitrage opportunity for Americans right now, honestly, is the US dollar is so strong relative to the Canadian dollar. So
Mm,
not only can you pick off like a bunch of markets that you can get like cash flow positive real estate, but you could do it at 50 cents on the dollar with the exchange rate, maybe not quite. And and then we have a very so we have we have no vacancy. Like
mm,
um we have a housing shortage really. And so which is why even though in a tougher market our home values haven't come off, we have a ton of equity, we have a housing shortage, people don't need to move, and so rental rates are pretty high, and demand for rental is pretty high, with some exceptions. Someone's going to listen to this and be like, I'm in this town and
yeah,
it's
not in
shitty.
Vancouver, downtown where my
Yeah,
condo is.
yeah. If you're Vancouver, if you're Toronto, yeah, don't call me. I get it. It's bad. It's a bad situation. But in a lot of markets, it's fine. And I tend to own my investments in smaller markets.
That's interesting. What I hear you saying is they have a good purchase to rent ratio, like the amount it costs to buy it, the purchase price, compared with what you can rent it for is actually cash flow positive in some of these smaller towns and cities.
Yeah,
And you have a really high demand. And so with the housing shortage, that creates good tenants. You can have your pick of the litter and they're going to stay in and they're going to take care of it because they don't have anywhere better to go.
yeah.
Those are good strengths.
And
Um,
I have a smaller portfolio today. Like I'm mostly into business and stuff. I have 3 or 4 businesses, and I spend my time there. It's where I invest my energy and my capital. But I own a half a dozen places. Nothing crazy, But every single thing that I own, if you sold that property today at current market value, you would for sure break even. Like none of them would be underwater cash flow wise, and some of them are positive cash flow.
wow.
or right around that break even mark. So, and you know, I live in Victoria, Canada, and my investments are close in proximity to that. So there you have it. Like, so there's lots of opportunity up here. You just have to know where to find it.
That's cool. I wanted to quick, we're going to go into our final 4 questions, but I wanted to get that math you did there. I want to dive in that for a second, that 8 to 16% thing. So here, I think it's similar to what I call the 1% test here, where if 1% of the purchase price, can you rent it for 1% of that? But I want to run the numbers on that and see if it's similar. So let's say we have a $200,000 property, and then you would say, what was the 8 to 16% thing? How was the math on
It's
that?
the same. So you're saying if it's $2,000 a month, right? That's your 1%.
So, so let's, whatever scenario you want to use. Yeah. So let's say that's 2,000 a month. Sure.
Perfect. So I'm just doing it on an annual basis. It's the same rule. So go 24,000.
Okay. So take 2,000. That's your monthly rent.
Divide that by 200. Now you get 12. You're smack in the middle between 8 and 16. Like the 1% rule is the center point between 8 and 16. So if you're leaning towards 8, it's great. If you're leaning towards 16, you got to think twice.
Okay. So what was the 816 though? How did you get to that number the reverse way? What was your math on that?
But it's the same. You just take, I stumbled on my words. You take the annual value of the rent and divide it into the purchase price. It's the same thing that you're doing.
Okay. So you take the annualized rent and divide it by the purchase price.
Yeah, exactly. Okay, so in your case, you go 24,000, divide that by 200, you're going to get a number 12. It's like perfect. So the 1% rule is exactly the middle ground on the 816 rule.
Perfect. Cool. I think it's a good test to, get a ballpark where you're at. And, and every market has different property taxes and insurance. I've been buying in some towns in Texas right now. And like, my gosh, their property tax and their homeowners insurance is insanity. It passes on a really good 1% if you just look at purchase to rent. But as soon as you throw in taxes and insurance, it's half or a third of what it should have been. It's crazy.
Yeah. So, well, there you go. So that's why with the 816 rule, there's a much wider range as opposed to a specific number. Then you're like, if you're pushing this way, you really need to look at all those other costs. If you're on this side of the number, you're going to be fine. And so that deals with that discrepancy. Yeah,
that's cool.
But there's lots of ways to slice. We're at the end of the day, we're looking at the same number.
And Jason, this is super fun. I know we didn't even touch into most of what you do in real estate and the tech you've built, the networks you've built. If people do want to learn more about you and research kind of what you've done and connect with you, what's the best way for them to stay in touch?
Yeah, you can find me social media. My handle is at Jason Henneberry. So I don't know if there's show notes or whatever. We can drop that in there.
Yeah.
And shoot me a DM if you want to track me down. Yeah. I'm
perfect.
Very,
do you have a website as well for your business stuff?
What's that? Sorry?
You have a website as well for your business stuff?
Man, I got lots of websites. I own a bunch of companies.
Cool. Well, we'll throw some stuff in the show notes. Whatever you send over, we can do that. But this is great, man. I appreciate it. I want to ask you our final 4 questions we ask every guest. And you can make these fire round, or you can go a little in depth on them, whatever you feel comfortable.
Oh man, I didn't. I have no advance notice on this, so let's go. Let's do this.
I like it. Say question number 1: if you could send a text message out, and everybody in the world is going to receive this text message, maybe some homing pigeons and places that don't have cell service, they're all going to get the message. What's it going to say?
Don't take yourself too seriously.
I like it.
Give yourself a break. And take your time. That opportunity that you think is like, I got to jump on it now. I promise you, man, it comes around again. It comes around again, and it comes around again. So take your time, and don't be too aggressive. Just really, that's all that one message like that.
I love that.
Yeah.
Question number 2: what is a recent book or podcast recommendation you'd have for our listeners?
Dude, it's this one, man. This is the best.
Besides the ones we're associated with.
Besides the one we're on right now?
Yeah,
that was a great question, wasn't it? Shoot. Okay, I'm going to be honest, man. I haven't read a book in a long time. I am so busy that I haven't picked up anything new in a very long time.
That's probably
I will tell
refreshing
you
to
though,
some listeners. They probably want to hear that because there's
you
probably a
want to
lot of
hear
listeners
that?
that aren't big readers, and they're like, "See, I can be fine without listening to 100 books every month. Like, I
You
can
want
be
the real
successful."
deal? Like I run 3 fully operational companies, multiple 7 figures. I've had on all of them. I've got a brand new startup that I'm launching right now. It's the newsletter blog. I've got some pretty cool like things that I've done, like super unique things where I've been able to grow an audience to 100,000 people in 90 days off it. Like I've got some really cool stuff that I do. I sleep in. I don't get up early. I go to the gym when I feel like it because I'm like, I need to clear my head. I have a
Yeah.
hot tub every day in the afternoon. I'm at home with my family having dinner in the evenings. I don't work too hard. I staff out most things. I do the work myself, and then as soon as I can, I hire people. I'm not greedy. I push most of the money that I make down. So I've got really amazing teams, frees up my time. All the stuff you hear online, like there's a lot of advice out there, man. If you want the real deal,
This is
like,
good.
yeah, I don't read books.
Yeah. I don't wake up early. I don't
I'm a mess. I'm the opposite of
hot.
everything that they tell you to do to be successful. Let me tell you
Well,
that.
I love that. That is such a good answer because one thing I think so many people do is they get this. Let's say it's a game. Let's say we're trying to win this game, right? They're
Yeah.
getting this fulfillment, their wins from
Yeah.
reading a book, from posting a thing, from being told they're special, from looking cool, from doing the morning routine. And they feel so accomplished by the time they're all done with that. They're like, "Oh, I'm good." But they actually haven't done anything that builds anything. And you're like, "No, no, no. When I'm working, that's what I work and I get shit done."
Yeah.
And then the rest is fine, So if you're lost and you have no idea what to do with your life and you're very confused, you're wasting your day playing video games, go read some books, wake up early, hit the gym, figure out what you're doing. Once you have a machine and you know your system, you know what you're doing, go do that as opposed to just getting your fulfillment off of another meme or podcast or feeling like you're doing something because you learned something.
I will agree when I've had down moments and stuff like that. Like I go to the gym like 3 times a week. It's not that I don't go to the gym. I'm not like 4 a.m. go to the gym guy.
Yeah, yeah,
Like
yeah.
that's all. So but I believe it, you got to move energy. I'm big on energy and stuff like that. I'm big on just respecting my own energy. So, but you're right. Like if someone's lost, if someone doesn't know what to do, well, then the first thing you should do is get that energy flowing. So like you said, like, get that body moving, get the energy flowing, pick up a book, get inspired. And I think those are all very healthy things to do. And then once you find your idea, then work hard at that.
Yeah. See, and I think the problem is so many, and I've seen myself do this. This is what I'm kind of like wrapping on this is like, you get the idea, you find something to do, but it's not as exciting as learning the next thing. So you keep going back to the podcast, back to the next book, back to the next seminar, back to the next coach, back to the next, instead of just doing the thing. Because once you find the thing to do, it's hard and it's boring and it's consistency and it's headaches and it's not as exciting as learning something new. But you won't ever grow and build unless you do the thing. So find the thing, start doing the thing, and just stick with it and kind of remove a lot of the distraction, which isn't as exciting. But I think a lot of people miss the
It's
boat
not
on that point.
exciting. Like, yeah, like it's our brokerage. We have the largest national brokerage in Canada. Our group funds 1% of the Canadian market. We fund
That's
5 billion
awesome.
a year. There's about 500 billion worth of mortgage transactions every year in Canada. So now I spend most of my time in that business, like fixing compliance and payroll
Yeah.
systems and shit like that.
Yeah,
Like,
you're putting
I'm
out
putting out
fires,
fires every day.
fixing boring stuff, but you're
Yeah.
doing the work that keeps the machine alive.
Exactly. I will tell you though, back to the book, I have read a lot in my life, and maybe I'm just going through a phase where I don't need to read. Great book. If you talk about like do the thing, like don't get distracted with other stuff. People talk about this one all the time, but Good to Great, Jim Collins, and that's such a good book. There's a philosophy in there, and I can't remember what he calls it, but think of everything you do as like concentric circles. Like, so you've got your core, and then you've got things that are outside of your core. So the how I got to a place where I have multiple businesses is I had my core thing, and my core thing never changes. And I make sure every single day that stays alive. and it is my first priority because it is the thing that gives me the cash flow that allows me to do other things. And then what I did along the way, though, is related to that core business. I wanted to express my creativity. And so to your point, like learn the thing that's new and that's sexy and it's fun. Yeah, for sure. And you need to bring in the, that kind of energy. And so I, at any given time, would have 2 or 3 projects that were outside of the core where I could afford to, like, any money or any energy I put in that, if they failed, was fine, but it didn't affect the core. But if I had a win, it would augment the core. And so I always focus my energy. And so my whole way of being over the last 10 or 15 years is I would have 2 or 3 side hustles, which essentially, and then one would maybe work and I would drop the other 2. And then I would focus intensely on making that thing so good that I could bring it into the core and it expanded my core. And then once that process was done, I would try 2 or 3 new things so I could get my kicks. And so that is Jim Collins' concept from Good to Great. Again, I can't remember what he called it, but it was like protect the core, expand. Like there's some kind of terminology he gives it. He writes a whole chapter on it. It's awesome.
That's cool. And I've read that book. I don't remember that part. It was a while ago. So I should go back and read it because I love that concept.
It might be another book. It was like 15 years ago. So
yeah, I'm pretty
sure it's that book. But
well, it's interesting when you read a book, say today versus 5 years ago versus 10 years ago, depending on where your head's at and where your life's at, you pick out different things that matter,
Yeah.
I love that concept though. Like find that core, get that core solid, never sacrifice the core, but still branch out and expand. And then you can build the core bigger and bigger. And that's where you see these people like you that are, vertically integrated when it's like, oh, we do a broker, but we also do marketing, but we also do this. And we're all, a lot of investors, they own rental properties, but they also flip, but they also wholesale, and they also, and the marketing for all of them feeds all of them. And it's like, that's a really good way to grow, but start with one, get the core, do the boring work.
It also allows you to have a decent life. Like we talked about, like I have a bunch of projects, but at the end of the day, they all feed each other and they're all related to each other. And I have different partners in different businesses, but the work I do over here feeds this and the work I do over here feeds that.
Yeah,
at some level. And I don't have anything in my world that is a distraction from ultimately what is like the core group of projects. And so that's like really critical. Don't just go build a bunch of stuff that's unrelated because you won't have the bandwidth to do it. And you hear guys like Dan Martell and Alex Hormozy, and they constantly tell entrepreneurs, they're like, do one thing. Yeah. And that is what they really mean is do one thing until you're ready to do the next thing, because all those guys have multiple projects. Like none of them only have one thing. But the problem with most entrepreneurs is that they start out and they get the kick, they get the endorphin rush from like learning the next thing, like you said. Yeah. And then they don't actually get the first thing to a place where it's self-sustaining. That's what they mean by that.
Love it, dude. That's awesome. We could do a whole podcast just on that principle. I'm glad we hit that. Cool. Okay, last 2 questions.
We were like, don't talk about the businesses, talk about real estate. Here we are, full circle.
I know. It's good though. And it's exciting. Yeah. So that was a good answer for not having a book. A response, the question was a good recommendation. Like, I don't have one, but let's talk about this.
I felt like I needed to defend myself a bit.
No, I loved it. That was good. Okay, next question. What is the most expensive or interesting mistake you've made in real estate investing?
Well, I mean, you heard my story earlier where I wiped myself out. I didn't have, I got too aggressive in one area, and that risk I took affected the other areas. That's a really good example of what we were just talking about, where I was trying to like expand and I wasn't prudent enough to make sure that expansion didn't kill me if it went wrong. And so, it was huge, man. It set me back like many, many, many years.
And I'll just point out for the real estate passionates, it wasn't the real estate, it was the business, right? Not saying you can't, it's just they're different worlds. My dad would always say that. He's like, I know a lot of people that have lost money, and almost every time it wasn't from the real estate. It's because they pulled the money out of the real estate to go fund something else that blew up in their face.
I have never lost money.
They're not the same thing.
I've never lost money in real estate. Yeah, but I've had expensive real estate related mistakes. I've had mistakes in my life that have caused me to lose money.
Yeah. So it's just interesting, right? And and obviously business is a whole other world where you can build a whole different level of wealth. So not saying it's not worth it, but they're just different.
Totally.
Okay, one last word. One last question. What's one word or short phrase to encapsulate why you love real estate investing?
It's not one word. I'll tell
That's
you what
right.
I
You can
think
do
about a lot. I think about a lot. Inflation adjusted returns.
it.
I love the fact I love the fact that like I know, like let's say I have a property today and it kicks out whatever, $3,000 a month in positive cash flow. I love the fact that I'm pretty confident that 25 years from now, no matter what happens, that I will be able to buy $3,000 a month in adjusted for inflation goods with that cash flow. That cash flow might be $9,000 a month then, but a pound of butter will be 3 times the price. So I love that, like, I know that I can buy the thing today and I can like do an analysis and say, if that mortgage is paid off, this thing will kick out this much today. Like, let's say it's $1,000 a month in positive cash flow. I know I need to own 10 of them to get $10,000 a month of positive cash flow. I know that if I just go do that 30 years from now, I will get $10,000 a month in relative cash flow. And it's predictable and I don't have to freaking think about it, man.
I love that concept. And inflation adjusted returns? Is that what you said?
I don't know what I said.
I don't know what it's good, but yeah,
inflation adjusted returns, inflation adjusted cash flow, something like that.
Cash flow. Yeah, that's so powerful. And that's something I love about it too. Cause I'm like, look, like people say, oh, how much you need to retire on? You go, oh, I need $4 million and I'm getting this. It's like, but that's all going to disappear and go down and be worth less and less and less and less. Like I say, anything I buy today, it's gonna, the world will become more expensive, but I can rent these out for more and their equity goes up. It just moves with it and protects you in a way that most investments don't.
Moves with it. And when you look at, I know this isn't one word, but when you look at, you go buy a rental and it might be a little bit underwater today from a cash flow perspective, but there is a point in time where it's never underwater again. And that's because you get a pay down on the debt and you get appreciation on the rent. Forget the property value. There is a moment in time for all real estate that all of a sudden it's like, I can't not be positive cash flow. Right. And so I like that. And I also like that the debt just gets paid off. And the thing I love the most is that you can always just go live in the thing. You can't go live in your NVIDIA stock portfolio, but you can go live in your 1-bedroom condo if everything goes to hell. And I like that. Now, I'm not saying it's the best investment. I'm just saying I like those things about it.
That's the cool thing about it. 100%. Yeah. Dude, this was super cool, Jason. I really appreciate it. I wish we could spend a whole hour just talking about business. Like I said, interested in learning about that. And that's your expertise. Well, this is great. Thank you for your time. I'm glad that we got to have you on the show.
Same. Thanks for inviting me on, Joe. It's been a great conversation. Appreciate it, man.
This is Joe Jensen signing off for the Real Estate Investing School podcast, reminding you to find your core.